Hey traders, good afternoon. It is Thursday afternoon and market's a little calm, so I wanted to come in and give you a review, look back, look forward if you will. We are waiting for the bounce. We obviously got through the largest of the distribution move. We're down 10% now in the indices. And as you know, I have been very bearish since last Tuesday. So I want to go back and review some of these charts so that we can kind of collectively look at the evidence and decide, is it safe? Is it safe? And you know that was the title of my intermarket chart attack. Is it safe? But let's go back first and foremost to Tuesday of last week. And I'm going to kind of go through this with macro to micro perspective, of course, because that's how I approach everything, not just price action on the surface. And that would not have really done as much good as I think I was able to do in the trading room by looking in the afternoons at the Intermarket Analysis to see massive distribution. But I had a feeling last week that something was just wrong. Tuesday I got really uneasy, and you knew it in the trading room. I said, something's wrong. And I said it kind of quietly. It was right after the headline hit of U.S. sanctioning Russia over Venezuela. And then Friday they actually sent out a release with the specifics. But the way the market acted, it was just not normal. We got lots of new not normal market action, but there was something unnerving about it. And you know, I was a bull going into options expiration last week, and I turned on a dime that day. So, long story short, I don't think this sell-off that we've just experienced is over, but I do think we are bounce worthy. So, we had Tuesday be the tremor, Friday, pre-earthquake, and then the big earthquake, then the tsunami, and now there's lots and lots of flooding, and, dead bodies will rise. I'm telling you, this is not going to be bankruptcy-free with a number of firms, and most definitely in the oil patch. But I'm not worried about that so much as I am the virus spreading, and I don't mean just coronavirus, but also this fear in the market, because the selling that has taken place under the surface is massive. Like, I have not experienced this amount of massive internal, under the surface, however you want to put it. I've got half a dozen Intermarket Analysis tells, and it has to be repaired. So we're going to go to some of those charts, but I do want to kind of emphasize, I put together a Monday review. You can see this, obviously, quant thoughts didn't help very much, if truth be told, because the level of 3150 was the put level. It became the call. It literally flip-flopped. The call wall was lower than the put wall. So clearly CTAs were blowing out their hedges, and the whole nature of the selling to me did not look like forced selling from CTAs. It clearly looked like natural selling as well as forced selling, and I think that's where we have a big conundrum. So we have Super Tuesday coming up. This is a big deal, no question. We have coronavirus headlines, we have the sanctions, but let's just be clear. The folks that came in to buy this market back here, okay, I got the repo here, September, so we got this late October, November, December, they're gone. They're wiped out. First in, first out. So that's one of my sayings. Okay, it's not just an accounting term, it's a trading term. So all of this lovely trend line breakout, and the bulls were raging. Well, guess what? Bears showed up to the fight, and they brought many, many guns. So, yeah, and the bulls just had, wimpy little pocket knives. They're broken now, the charts, right? You can see that, I can see that. I don't think this is going to be a V-shaped in any way, shape, or form. And I was very convinced of that on the Christmas Eve massacre. The 20% drawdown from October 3rd to the 24th, I predicted 1 week beforehand that this would be a V-shape and head back up. And I will show you those charts. I've written about this. That's not what I'm here to say. It doesn't look the same. It looks like this is not done, is what it looks like. So we can have a bounce. This is true. We have the contango reversed into backwardation. I also mentioned that with VIX, there was a great tendency for some portfolio managers to get the heck out when VIX went into backwardation. And I mean, they just go out, and then once it goes back into contango, they come back in again. So there's natural selling, there's forced selling, there's first in, there's first out, there's, backwardation, backing off. The U.S. sanctions. You had Sanders winning Nevada. You've got definitely Super Tuesday risk. Coronavirus is a big deal, even if Trump doesn't think so. Japan just shut down all of their schools for the entire country. So it's not for nothing. There is much more fear that we are trading, right? And it is not going to be resolved by repo, by Fed printing, by Bank of Japan printing. ECB says no, they're not going to do a monetary policy on coronavirus. So there is some pushback. To me, this whole setup, and I have said this for a while, right when we actually in November, totally. November into this high, which was the IPO extravaganza, right? It was like 3 months of just solid buying. And then my last video, I said, nope, it's tired. And I also said 33.80 originally. That was back in February, late January, early February. We would run up into 33.60 to 33.80. That was a sold to you market. There'd be distribution underneath the surface. I mentioned this tagged the 10-week once. Then we had a nice tag again. I said the third time it would be taken out. It was a ginormous gap down that all the bulls were excited about. Let's buy the dip. And most of them got taken out. Here, and now they're now a little bit more tepid. A little bit more reservation here because they tried, they died, and now they got to buy. So we're waiting for them to buy. Okay, that's my whole thing this morning was we're going to get above, if we're going to get above, 3027, and we can stay there, which is a 200, which is the 50-week. Okay, fine, we can have a little bounce. I am not bullish, and you know that. I don't think tomorrow, magically, pension funds are just going to swoop in and they're going to buy. Not into the weekend risk. And I also am very fearful about something, which is bonds. So we've had this phenomenal run up. I had 152, you know this, in TLT. My TNX was clearly taken out. Okay, so I will admit I was a little shy here on my price target. This is the next one. It needs to get above. It needs to get above and stay above, and we're not there yet because there's too much fear. But it is an exact 100% retracement. So is XLE and a whole bunch of others that look just like it, right, that are rate proxies. So getting back to bonds, the CTAs, if you will, these trend-following quants, portfolio managers, big asset under management books, okay? We're talking big. They clearly are, making money on their puts, but they have not they have not come in with calls yet. So they're not there, they're not in, they're not committed. Retail's blown out. We have all the headline risk we've talked about. But I think the bigger issue right now is bonds could actually sell off. I know that sounds like, what? So stocks should go up and bonds should sell off. Not necessarily. So I think that right now the risk is that we've got this treasury futures that were bid up like mad by the CTAs. Okay? So they're gamma negative, and we got all this, let's buy bonds. There's a bond frenzy party that went through the roof, okay? In the same way that there was a stock frenzy party that went through the roof. I think that's going to get unwound. I don't have any indication of that yet, zero. And a lot of this, of course, people are going to say, but there's no inflation. True. Oil fell down to 45, which was the handle I was looking at before stabilizing. Rates are lower than I expected. I did not expect that they would fall so shockingly through my 1.3 plus area. So I will admit that kind of took the overshot move for me, and now I got to see it back inside to be bullish commodities for a bounce. Bullish oil, and it's a rate play. So, but I think bonds are definitely an issue. And let me talk about volatility. While these lovely CTAs have been making hay while the sun shines, and lots and lots and lots of distribution under the surface, the VIX is not done. Nope, not done. So it's hit my price targets, no question. And I had said 28 on Tuesday. We digested. My next target was 36. We hit 36 as a high, and literally in my room I said, okay, I think we're done selling for the day. So we've hit my second price target. That was the this last one. December 2018. But we're still inverted. That's trouble. Credit is starting to blow out, and I've checked with my, fixed income folks, the oil traders, the fixed income traders. What do you see? I do that, right? That's my value add to you. I want to know what the heavy hitters are actually hitting or waiting for the fat pitch. You know my analysis. You hear it, you read it, you know my technical chart, let's say supporting documentation, but this still looks bullish to me. There's nothing right now that has turned, and it might take a little bit. So I want you to be a little patient if you can be. We have way too much risk in botched headlines, meaning we had the WHO and the Senate hearing, and that was before Trump's conference last night, which I thought was painful, embarrassingly just dismissive. So it's a little worrisome, right, as this spreads in the U.S. for market participants to buy, because we don't really have a bullish thesis right now. And we have Super Tuesday coming in. The VIX is still under unwind. The Treasury futures, in my opinion, are next to be unwound, which will set off short covering in value plays and sell off in tech. Tech has not sold off, relatively speaking, as hard as the others. You can see clearly we're not anywhere near the November breakout levels. So I'm waiting to see. Yes, we're on a 30-week. Apple approaching 30-week. Forget Netflix. It's a coronavirus thought. NVIDIA still above the 10-week. Haven't even broken the 10-week. Morningstar reversal. Amazon broke the 10-week 2-bar reversal. There's all kinds of stuff that's nasty in the tech space, but it's only a pullback. It's not a correction yet. That not like the SPY and the diamonds and the small caps, which really gave sway. And my intermarket analysis tells our Ziff, right? We have support of sorts. That's one way to look at it. Here's another. Here's a trend line, right? Ziv totally failed, broke the 70, basically 71. But I was looking at, well, if we can bounce off 67, nope, we came right on down. So there is nothing bullish yet, except the intonation that we might do this. Last time, we tagged, came back in. The next week, we went down again, not a double bottom, but a retest, but it was a higher low. That's a pattern versus a retest and a higher low. So my point is, coming right in might, for a day or two, prove helpful, but I can't help but think tomorrow is potential pension buying, but that's going to be countered by all of the fear of exposing a portfolio that already has losses probably to weekend risk in front of Super Tuesday. So I'm not sure the pension buying end of month is going to negate that fear, that risk off kind of modality. So I'm still, and I've written this before, this to me was going to be a volatile week. It started a little early before options expiration, and that cleaned out the CTAs. They went, from gamma positive to neutral to negative, and they're heavily now negative. Volatility is still percolating. The S&P is not getting up off the 200. Doesn't mean it can't tomorrow or the next day, but nothing about this to me says bullish. And when I look at the Qs, and I've already done this in the trading room, so I'm just reminding anyone who wasn't in the trading room, the Qs still haven't even touched down to the same place that the other indices have, and they're way too supported. So my thinking is, if value, I've got to show you this. This is the most recent, some of these technical charts as well. Remember I showed you this in my intermarket analysis, right? This little red arrow was resistance. That represents the S&P, but more importantly, the tech, the heavily weighted, because this is an RSP, which is equal weight, okay? There is an absolute 1987 style massive distribution going on under the surface. Those are my words. Nobody has been talking about this massive distribution. We are 17 to 1 in sell-off. It's ridiculous, and it's been like that. 98% of the market is selling off. We're talking 3 days in a row. And Friday doesn't even count, right? With the gap down, Monday, Tuesday, Wednesday, Thursday. It's been 5 days. Typically we have a little bounce. But value isn't really getting up off the ground, but this contingency of, is definitely coming back in. Alligator jaws are starting to close. But what I wanted to also go over was we don't have, so volatility. I had 2169. Hold on, I need to put this over here so I can actually have the right stuff showing. All right, let's go over this. So 36, we get above that, that would be incredible, incredibly bearish for the market. I would not be surprised if we kind of like a regular stock, maybe this isn't even volatility. We're just kind of like, there's the 3 day, right? Breakout, digest, we got to 28. That was the first call, my first price target. Digest, breakout, got to 36. We should digest. But I don't think we're going to have any big V-shaped, I think we will have a 50% retracement of this collapse in the past week. I don't think it's going to be starting tomorrow. I think we need to get through Super Tuesday, honestly, and then start. Sell the rumor, buy the news. This is still working as well. Obviously, gold is staying bid. Bonds are staying bid. I am worried about, however, bonds being unwound. We clearly busted through NYSE. We're going to go over my intermarket. We went right down here to my yellow line, which is why I'm showing these charts, right? So the idea was, I tell you where it's going. You trade your own risk tolerance and size and all that jazz. We are now there today. This is triple level of support. We go through that. It's a small exit door. We should stabilize. We should try to bounce, do a 5% bounce, replace half of that correction, and then set up for lower. Why do I think we're going lower? Because I think tech has yet to sell off. And tech is in every single portfolio, ETF, hedge fund, mutual fund, you name it, passive investing at its finest. They're going to defend that, in their dying hand. So they're selling everything else off vigorously, right? Coronavirus, airplanes and cruise ships and hotels, those are extremely extended. Banks on rates. 400% increase in some of these speculative vaccine plays. But the point is that we definitely have seen my intermarket analysis price targets hit. And honestly, this is just complete. Guild is already up to 80 today, and all this stuff has broken. So you'll see where I had price targets. They have all been tagged as of today. And this is kind of what I wanted to point out. The Qs have not. And bonds obviously are strongly bid. They have not been unwound. But if you take a look, for example, the SOX has a little bit more to go. So semis, which is part of tech, have not sold off like, let's say, the weaker, more speculative bets, right? So space became a teenager again from 32 to 19 in 2 days, and well-deserved, it should be. It's a $250,000, space flight. Let's worry about other things. So these have, for the most part, pulled right down into their price targets. There are a few left. Palo Alto was part of Hack. They had earnings. They were the first one to really hit their price target. And I got to tell you, I said in the trading room, I read some very nasty fundamental analysis on Palo Alto. It's a short, and it continued falling, especially with this weak market. Square, on the other hand, had great earnings. So you can still get pockets. Netflix, seen as a coronavirus, safety play, but once it breaks this trend line, and it's filled the gap since now, right? So this had to hold. It has filled the gap. But if this trend line is to break, it is a beautiful short, right down from 360 to 280. So tech is still holding up. Forget that. Palladium in another day. Let's see. I mentioned volatility is staying bid for all the reasons I've talked about. The CTA unwind. Super Tuesday basically is the unwind. CTA positioning. The botched press conferences, inversion, yield curve inversion, sold to you, mindset, because underneath has been massive distribution, coronavirus fears, actual and real, Sanders, U.S. sanctions, backwardation, first in, first out, all these really good reasons. Is it safe? You know what? There's going to be a likely bounce, and it's going to be probably a strong one. It hasn't started today. I have reiterated that this was forced selling meets natural selling, and the entire concept I've had is massive distribution under the surface, and that is so important because it indicates a very real possibility that vol targeting strategies have yet to become meaningful sellers. So even when I printed this, which was 2 days ago, I was still convinced selling was not done. Everyone else racing in, let's get the dip, let's get the dip, let's get the dip. Well, I don't think it was safe. That's why I wrote what I wrote. But I am now saying we are definitely into some price targets. 34, for example, for Nasdaq volatility. Not done yet, I said. And this was, the 25th. We cleaned through that to 30.50. We actually went all the way down to 307. This is still intonating a mess. We got to repair some stuff. My NYSE, oh my God, we blew right through that, down into 12,800, right where my arrow is. This is from 2 days ago. Selling's not done, I said. I don't know how else to emphasize that. So now I think we are worthy of a bounce because so much of this stuff has been, feel lucky. That was a joke, right? So I actually had written, what was the Clint Eastwood, feeling lucky punk? Well, are you? Okay, I didn't do that. I pulled back, but that was my feeling. Anyway, so we have a sold to you market. A bid disappeared last night in the futures market. It was wide. It's the most liquid thing on the planet, and it had lost a bid. So that was after Trump had spoken with nonchalance about the coronavirus being nothing more than the flu. The breadth. Let's talk about the breadth because I have several indicators, and these are the major ones, right? This T2123, which is exclusive to T2 TC2000, showed me that we were in wicked distribution, and I was shocked in my realization that this was the largest day of internal selling on Tuesday, which is why I was so, forgive me, but hell-bent that we had more to come, because that didn't fit right? That the prices had come down. This had broken the 10. It was on a trend line. And by the way, remember, if you go back, you'll find a chart where I said, here it is, the beginning of January. We're forming a morning star reversal. We'll have to watch that and see if the gap fills. It didn't fill. And then this was Friday, right? You can see it Friday, Monday, Tuesday, and it was Wednesday when I took this in the morning. Okay, so I took this right before in the live trading when I was going over intermarket analysis. Well, we got down to 0 today. 0. 2 days later, we're all the way down here and flatlined at 0. Well, it can't stay at 0. Can't go below 0. So it makes sense that we should bounce, right? But it can stay oversold for longer than we expect. So this was one indication, but that particular bar on Tuesday had never seen such a big bar. This is just scary when I think about the amount of distribution happening underneath the surface. Another one I will show you. Yeah, so here, today we're here, this yellow line. Ziff, I've shown you. All of this stuff. This is up 400% now. I know, crazy, huh? Just keeps going up 100% at a time. Rates, I'm waiting for rates to bounce. Chris Kimball sent me those. I already got my, is it safe yet? Bounce worthy. My bounce worthy charts were here. 76.54 is the NAMO, which is Nasdaq. And I got another one here, which is the SPY, NYSE. So they were both very oversold. So I can show you that this is clearly exciting to have an oversold reading, but you actually have to have confirmation and follow through. So here's what it is now. By the way, I'm going to try and get this out to you before I head out. So we went a little bit lower, okay? Oops, sorry. This is an end of day, so it doesn't even show today. We went a little bit lower as of Wednesday, even though I took the picture this morning before the market opened. It actually is not for today. I have to do this end of day. That's what this means right here, EOD. It's going to be a little bit lower, so that would give me more confidence that we're going to have a bounce. All the price targets have been tagged, and we have this oscillator that I have used before, right, to indicate, for example, that was the Christmas Eve massacre. For example, this was the February, the 2-week drop from January right here. We got here. So we're already below the January drop in this. We should have a really nice bounce coming up, but we're not there yet. That's all I can say right now. We're just not there. This, I have, let me take another one. Where the heck is it? Hold on, hang in there. I've got to take another picture of it. Okay, well, trust me when I say this is now here, okay? So we're now right here, right? We hit 3,000 and we're stabilizing. That's a lot of levels of support. We've pushed into some oversold territory, obviously. We've pulled back dramatically, obviously. Value has not really picked up. It's been sold off. Remember I mentioned this was really scary. We go through 2 levels of very important support and it still looks lower. So I don't think the market is in any way, shape, or form safe to load back into that portfolio. But I do think we have a tradable bounce coming up. I am going to be watching. This is another end of day, so I can't do anything until 8 o'clock tonight, which bugs me, but that's how it works. They reload their data at night, which is, if you're ever wondering why I have these late night, insomniac attacks, it's really because I can't get data from this company until 8 or 9 o'clock. They're on California time, and they just don't give us the end of day info until it's their end of day, even though the market closes here. And anyway, I'm getting on a rant. The divergence, right? We had Nasdaq moving higher. where underneath the surface it was moving lower. You know that I saw resistance, if you will, of the accumulation, the NYSE, falling. So many charts are indicative of distribution underneath the surface. For example, this NYSE, that is very impressive selling. T2123, which happens to be the cumulative 4-week high-low, that is massive selling. Underneath the surface, just really, really impressive. Another one is T2104, which is cumulative volume. That's just unprecedented. Like it took a month to equal that 1 bar. And that was in our 10% drawdown in the month of December. So this one huge standard deviation move in volume is another reason, it's one of many, I see massive distribution underneath the surface. And yes, we can have a snap back, but I in no way believe it's going to be V-shaped. So we get back into this area right up here. Nice. And then I think it's a reshort. And I still have this pattern kind of going, looks like a head and shoulders on a weekly. That was a Morningstar reversal on a weekly, followed by the low, if you can see this, of a Morningstar reversal pattern on a weekly at the December low. Look at this beautiful Morningstar reversal. Now, you know I've been spying these. We break out, Morningstar reversal. Uh-oh, man, maybe I'm wrong. We're going to come up here and tag. Nope, we were not. We just completely fell out of bed. So, I don't want to, this was, another idea that I had in the trading room where it was IYR was looking like a Morningstar reversal was going to break. It did. XHB, which is an ETF for home builders, which has been a hedge fund hotel, doesn't look so bad here. Just came down and tagged, largely because of Toll Brothers. They're still, quote unquote, that's not holding up. That just took out all the gains from September. But the point is that even the very, very few ETF sectors that were holding up as the safety trade are broken. So, what's not broken? TLT. I'm not even going to talk about gold because it's another animal. Yeah. Not even gonna. But we have these, I believe, a potential for a treasury unwind, which would move rates higher, which would cause more tech selling. That does not look like it is done to me. I think small caps, they broke the 100 week. They typically do. That's their pattern, right? Diamonds, right down to the 100 week. Last time it was here, it had a very nice reversal. So in other words, it overshoots, then it's tight, overshoots. So this should go back into sideways again. SPY is a different kind of creature because it's so widely traded and such. This to me is, again, a retracement of that breakout, which was a pretty important breakout with massive distribution under the surface and all kinds of reasons to sell, very few to buy. I think this is not done. I think we bounce and then we're trounced. So I wanted to share that with you. This was not a day trade setup. You'll see more charts tomorrow after I get my end of day data tonight. Do the trading room and then I'll put that stuff together on Friday. And right now I will wish you a great afternoon and be safe. I think we have some opportunities here to, let's just say, really be careful on size. Lighten up. The volatility looks dangerous. Bonds, to me, look fine price-wise, but underneath the surface, so did the S&P just 1 week ago. And I knew something was broken. So be careful. Something looks dangerous right now in treasuries and bonds and credit. And I think we've had our currency shakeup Remember, I wrote about this on last Wednesday, and I said it's not bullish. It's actually very bearish that the yen fell out of bed. It's going to hit equities. It did. So I think now we've got bonds as a big red flag. So if you are heavy into bonds, just take care. I think there's something in the works here. And yes, there is a beautiful red, where the heck is it? There it is. All right, there's a nice long trend channel, right, from '09. That's another reason to take care. So it doesn't look like anything's wrong with this yet. And the same warning I gave last Tuesday, something was broken in the equities market. I smell something about to happen. And I think it's going to mean bonds and tech and credit are going to be our next epicenter for an earthquake. Take care.